Hello again, options traders. I hope everybody's having a good trading day today in the markets. And this video is a special request from one of the traders in our group asking about the math of rolling. And he posted in Facebook and said, I'm a little confused about some of these rolls and how to track my cost basis. And it's actually fairly simple, but it definitely can be confusing if you don't understand it. So I've talked about rolling in previous videos, but I've never put them together with the longs and the shorts. So let's take a look at a little more detail, but we'll also look at rolling long and short options. So before we do, as always, please be sure to click like and subscribe. Definitely very much appreciated and helps so much to promote the channel. So let's back up to the beginning. Be sure that everybody understands what is a roll. Well, when we use the term roll in options trading, it really just means to switch. You're switching out your current contract for a different one. Could be a different strike, it could be a different expiration, or both. So for instance, if you buy the $100 call and you sell the $100 call and then turn around and buy the 105 call, you've rolled it. And of course, we typically do that in one trade because that is a short vertical spread. We're selling the 100 call, buying the 105. It's these two trades right there that make up the short vertical spread. We're selling the 100, buying the 105. But in the end, we're just swapping out the long 100 for a 105. Now, why do we do that? Well, there could be a lot of reasons. Basically, it's to lock in some cash, but still maintain some exposure or some deltas. So for instance, let's say that we buy the $100 call for 6. So there's our bend at the 100 strike. There's our cost at 6. And at a later time, let's say that we can roll to the 105 for a credit of 4. So we would switch from the red line to the blue. So if you paid 6 and then received 4, you now have a net cost of 2. So the main reason for doing the roll is to shift this maximum loss portion up so that you're reducing the most that you can lose. Now remember, when we roll, if this is a $5 roll, as in this case, we're swapping out the 100 for the 105. There's $5 of difference. And when you do that, if we get a $4 credit, there's a trade-off. We're going to shift that break-even point out by the remainder, or $1. And so that's why you want to be sure that you're getting fairly healthy credits for these rolls. You don't want to be rolling for 50 cents or $1 because then you're pushing your break-even point way too far out. Now, if you get into an ideal situation, you might even roll into a cost basis that's better than free, what we call a negative cost basis. And so now, if we got another $4 credit, we could move from the blue to the green, and notice we have a guaranteed gain here. And yet we still have unlimited upside potential. Okay, so how do we do this? How do we switch from the red to the blue to the green? Well, this is where we get into rolling the long calls. So to roll a long call, you're going to short vertical spreads, which is what we just talked about a moment ago. You will sell the long call, that would be to close, and then you will buy a higher strike, and that would be to open. So let's say that you have the $100 call. All right, so we're long the $100 call, and then what we're going to do is to create a vertical spread, a short vertical spread. So notice what happens if we put in a short vertical spread into our account. That's what this trade is, right there. What happens once this trade is executed? Our long 100 gets canceled with the short 100, and now we're just holding the long 105. That's how we're walking up that graph from the 100 to the 105 and 110 and so on. So even though it looks like that call option is just shifting higher, what you're really doing is selling vertical spreads. So this is what it looks like. Here we've got the 70 call. If we sell the 70.75, we're just going to end up with a 75, but we're really selling this 70.75 vertical. If we sell the 75.80, we go to here. The 80.85, we go to here, and so on. And that's what's allowing us to just walk up that line, continually sweep in credits, and reduce the amount we can lose, but also still have some exposure. So the question is, how do you track your cost basis with this? Yeah, it does look complicated. You got buys and sells, but it's actually very easy. Just simply track the money. So let's look at the simplest of examples. Let's say that you buy the January $100 call to open, you spend $6, and then you just close it. This is the way that most traders place their trades. They buy it, and then they close it, and they move on to a different trade. So if we sell the January $100 call to close, let's say we sell it for $8, That's a $2 gain. It's just the net between what you spent and what you received. So now that you have the basic idea, let's do a little more complicated one. So let's start with the same trade that we did before. We're going to buy the January $100 call. That would be to open. We're going to spend 6. We will sell the January $100 call to close and collect 10. And then we take that cash, we buy the January 105 call to open. So notice what we've done. We've closed the 100, we've purchased the 105. We've just done it in a single trade by using a vertical spread. So at this point, so far, we have a net debit of 2. We have spent a total of 12 here in red. We've collected 10. So on a net basis, we have spent 2. So right now, my effective cost basis on this 105 call is 2. Well, just keep tracking the money. Let's say that we sell that January 105 to close. Maybe we sell it for 10. So at this point, we have a net credit of 8. And that's because we have spent 12 and we collected 20. So that's our overall net credit. Notice this is a closing trade. So we're out of the position, and that is the final amount. So it's really just that easy to track the money. Okay, let's now try it with short options. It's exactly the same idea, you're just starting off with a credit instead of a debit. However, short options are usually rolled in 2 different ways. They are either by selling calendar spreads, if you want to keep the strikes the same, or by selling diagonal spreads if you wish to roll up and out, or perhaps down and in, all kinds of combinations. But as long as we're changing the expiration date and the strikes, it's going to be a diagonal spread that we will use. So again, let's go back to a $100 call. Let's say that we are short the January 100. So this might be part of a covered call. And at a later time, we place this trade. We buy this January 100 call, that one right there, we're closing it, but we wish to sell the February 100. Notice we're keeping the strikes the same. So this trade right here on the right is a short calendar. Why is it short? Because we are selling the more valuable option. They have the same strikes, but this one has more time until expiration. So no matter what January is selling for, we know that February has to have a higher price. So that's going to be a credit, and that's what's making it a short calendar. But once we execute this, notice that your short January 100 cancels with the long, and you're just left with the short February 100 call. You have rolled from the January 100 to the February 100. So how do we track the cost basis here? Well, let's start out by saying that we sell the January $100 call. This would be an opening trade. We collect $2. So we have a $2 credit, but remember, we can't just walk away. We have an open position. It's a short position. We either have to let this expire worthless or buy it back at some time. And if we buy it back, we're going to subtract it from this credit. So let's say that at a later time, we buy this January $100 call to close, but we sell the February 100 call to open, and we also collect another $2. So now these have closed. We initially sold the Jan 100, we buy it back right here. That's why this is a closing trade. So right now we're just short the February 100, but we have a credit of 4. 2 from the first trade, 2 from this one. At a later time, let's say we buy the February 100 call to close. We're just closing this one out. And we sell the March 100 call to open. Maybe we get a credit of 3. But these are just simply calendar spreads. We're buying back the current one, selling the same strike but for the next month or the next week. But it's a calendar spread. So right now we have a credit of 3 and 2 is 5 plus 2 is 7, but we're short this position. We're not out of it yet. We either have to wait for it to expire worthless or buy it back. And if we buy it back, that's going to be subtracted from this $7 credit. So let's say that you buy the March $100 call to close. That's closing this trade out right here, and maybe you spend $3 for it. So now we have 2, 4, 7, but in order to get completely out of it, we had to spend this 3. So 7 minus 3 is 4. We ended up with a net credit of 4 through all of these trades. So again, hopefully that just shows how easy it is. If it's money spent, make it a minus sign. If it's money coming in, make it a plus sign. But remember, don't get too excited if you still have a short position. If you're rolling into a short, because you're going to have to close that out and you're not really sure what that amount's going to be yet. But once you have closed out, just go through and add up all of the debits and credits. So once you understand the calendar spreads, it's exactly the same thing for the diagonals. They're just technically slightly different trades. Let's say that we start out by selling the January $100 call to open. We get a credit of 2. Now we want to buy this back to close. We sell the Feb 105 to open. We get a credit of 1. Later we buy the Feb 105 to close. That's to close this one out. And we sell the March 110 to open. We also get another buck. Right now, we have a credit of 2, 3, and 4, but remember, we're not out of the trade yet. We still have a short position. So if it expires worthless, yes, we'll keep the $4. But let's say that we end up closing this one out. We buy the March 110 call to close for $1. What's the net credit now? Well, now it's 2, 3, 4, and then minus $1. So we ended up with an overall net credit of 3. So again, I hope that really helps to answer the question. It's a super powerful tool. We can go in the other direction too. There's sometimes we might want to roll down, but right now I'm just trying to give you in one direction, rolling up with the calls. We can do the same thing with puts in the other direction. But the whole point of this video is how do you track the money? And it's very simple. Just remember to add any credits that you get, subtract any debits, and then just make sure that the entire position is closed. Go through and sum them up, and that is your net credit or debit. But it's really important to understand your hedges, rolls, and morphs. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.